Today I'm going to cover a piece from Mike Wilson. I started playing Mike Wilson about a year ago. Have played several pieces from him over the past year with his predictions of what's happening and going to happen in the market. Mike Wilson is getting validated. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 24th, 2023. As I said, I'm going to begin with Mike Wilson. I started playing him about 10 months ago, and the predictions that he was making, he put a timeline on them for late first quarter, sometimes second quarter. So I kind of read that, March, April, May, maybe even June. Well, he was correct. However, his timeline was off, and I can't explain why, but everything he said has come true. He was being criticized. Now he's being validated. So I would say it's probably 4 months late, 5 months late, but the market has started to come down. Actually, it started to come down about 3 months ago. So, but now definitely is more validation. He did this piece, so it's a little bit dated. It's 3 weeks old. However, it is more true today than it was when he recorded it. So I couldn't find anything more recent, but I wanted to play this because he describes really what's going on in the market. And again, I think it's correct. And he gives some reasons behind it. Very well done, as he always does. So take a listen to Mike Wilson.
How much pushback, we talked about this before, do you still get the same degree of pushback that you did a month ago? Or are more people listening and saying, wait a second, in the anecdotal data, this is starting to make sense?
Yeah, look, I think the question for investors is always price. We're in a late cycle environment. Let me just set the table a little bit, right? So we're in a late cycle environment for the last year. And when you're in a late cycle environment, there's a lot of uncertainty, right? People erroneously called for a recession in the first half of this year. It didn't happen. And now they may be erroneously believing in like this beautiful soft landing with some reacceleration next year. They probably overpriced that in the summer. So what happens is investors get whipped around by price action. And I would say what's happened in the last 2 months is we are seeing a breakdown again in a lot of the stock market. Okay, yeah, the overall averages are down 4 or 5%, not a big deal. But some of these consumer stocks are really, really struggling. And I think that reflects kind of what we were talking about a minute ago before we get on air, which is that the middle, lower end consumer definitely is out of excess savings. That's starting to bleed a little bit into the higher end now as well. We have the student loan moratorium. And I just think that's the wild card. That is the risk for the fourth quarter is, can the consumer continue to surprise on the upside?
Art Cashin is the director of floor operations for UBS on the New York Stock Exchange. He's been on the exchange for 60 years. So I don't know his age, but I suspect he's well into his 80s. He is full of wisdom, and on CNBC, they seek out interviews with him all the time. So again, because of his wisdom, I want to play this. He has a couple of insights I thought that were interesting. One is the reason the market, particularly the bond market, is struggling and going down so much is because the big buyers, two of the big buyers of our bonds are China and Japan. China is in disarray, and Japan has shifted their focus over to their own bonds. So those two big buyers are pretty much not buying our bonds. And that's, in this supply-demand world, that's going to cause prices to go down. The other issue he tackles, which I thought was really interesting, I kind of dismissed it, but he said the issue around the House of Representatives voting for the Speaker of the House, and it's now been 17 days and no Speaker of the House. They can't get a majority vote. And so that, he says, is kind of a cause for the market instability. And I thought that's kind of weird to me. But he says why. And so I'll let him explain it to you. And I thought it made sense. So there are many worries about in Wall Street, but I think that one adds to the other concerns causing market instability, both in stocks and in bonds. So take a listen to Art Cashin.
Stocks in the red this morning here as the street heads toward the close of the worst week in a month. UBS Financial Services Director of Floor Operations Art Cashin joins us this morning on the CNBC Newsline. Art, can't say that you didn't warn the street about the prospect of heightened geopolitical worries, the prospect of higher yields. I wonder if you think 5% is any kind of ceiling now.
Actually, the technical ceiling on the cocktail napkin side, Carl, is probably around 5.25. But we did touch it yesterday very briefly in after hours. Traders are watching. What you've got there is a push-pull between the flight to safety with all these wild things going on around the globe geopolitically, and the fact that the usual buyers of U.S. bonds, the Chinese and the Japanese, are pretty much elsewhere. The Chinese are having their own economic problems. The Japanese are trying to get things started. So the normal buyers aren't there, and that's why yields are going up despite what should be a general flight to safety. And then to take us way off course, Carl, this thing with the Speaker of the House is so bizarre. We're in a near state of war, and heaven forbid, and I say heaven forbid, if something should happen to both the president and the vice president, ordinarily, the presidency would then move to the Speaker of the House. But would it move to the president pro tem of the Speaker pro tem of the House? And what are the constitutional rules for that? And to make it even wackier, only the House of Representatives can declare a state of war for the nation, and without a full Speaker of the House, cannot happen. One can only imagine that in Moscow and Beijing and other places, they're sitting down and saying, it's a very confusing American way of politics, and can we do anything to frustrate it? So right. May you live in interesting times, and here we are.
Next, I want to play a clip from Mohammed El-Erian. Again, like Art Cashin, he's full of wisdom, and he has insights that are unusual. And he tackles the Fed. He is very hard on the Fed, and I think rightfully so. He says this is the worst Fed chairman, meaning Chairman Powell, that he's ever seen. And he says what he's doing, what the Fed is doing under his leadership, is that they're managing monetary policy through the rearview mirror. In other words, they're looking back at historical data, and that's guiding their policy. He said what they ought to be doing is looking forward and having a vision for what they want to have happen. Yes, taking into consideration data, but looking forward, which they don't have. And so anyway, he describes this very well, so listen to Mohammed El-Erian.
You've talked a lot about how hypersensitive this Fed is to incoming information and the lack of a strategic view looking out beyond November, beyond December. What needs to take place now?
So I think they need to pivot from excessive data dependence to data dependence that has a greater forward-looking component. And that's what I was hoping would happen this week, and it hasn't happened. So we are going to remain in the situation of great uncertainty because there is no vision as to where this economy is going. And remember, John, it's not just about the uncertainties to do with financial accidents with the economy. It is about the serious debates, and Chair Powell referred to it. Where's our start? What are the lagged effects of monetary tightening? What about QT? What about the monetary policy framework that's outdated? So there's a lot of things that need to be discussed and fixed in the Fed complex.
Is it a mistake to address that with any kind of vision, Mohammed, when you just don't know? What do you say?
You've got to have a vision, John. You cannot drive a car without some understanding of what the road ahead looks like. You can't just look at the rearview mirror and try to adjust to every curve you just had. That's not how you drive policy. And it's certainly not how you drive policy when the impact of policy happens with a lag. So yes, you've got to have it. This is the first Fed I know that hasn't gotten it.
Well, let's go one step further, Mohammed. What would your vision be?
Sorry? So my vision right now, as you know, is that we live in a world where the supply side is a problem. We're living in a world where the US economy is weakening. Therefore, be careful of too much hiking. That's the balance of risk, excessive hiking. We still have the lagged effects in the pipeline. We still have the QT effects. So I would make it very clear that I'm unlikely to hike unless I am surprised in a very big way by the lagged effects not happening. I would also add that we need to have a discussion about the path to lower inflation, because there's a risk that if we try to get to 2% too quickly, we are going to break something in the economy and something in finance, because we're not relaxing the supply side problems.
The final piece I want to play for you is with Scott Wapner from CNBC interviewing Jim Lebenthal and Joe Terranova, and talking about the market and what's causing issue in the market. Terranova wants to very much focus on bonds, but Lebenthal is more focused on equities. And they bring into account the Middle East. And I think, of course, with the war going on over there, that is creating uncertainty. It has a lot of implications, both, internationally, as well as this thing could escalate very quickly, could drag other countries in, etc. So he thinks among the other risks in the market that is weighing on the market. So Lebenthal comments on that. So take a listen to this.
Carl, thanks very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the true state of stocks with earnings, interest rates, and the war in the Middle East impacting sentiment. Markets are on the move. The investment committee is here to guide you through all of that. Joining me for the hour today, Bryn Talkington, Joe Terranova, Jim Lebenthal, Steve Weiss. Told you the markets are on the move. The market, there you go. Stocks are down. And rates are up. There's the 10-year, 491. Joe, to me, that's really the biggest story to talk about. You had two things to keep your eyes on, really, over the last, now you move forward here, earnings and rates. Earnings have been pretty good for the most part. Rates are not going in the right direction, though.
100%. To a certain extent, you're watching oil a little bit, but it's about 10-year, and it's about the 10-year approaching 5%. 30-year above 5%, and this is a challenge. This is a problem. We know what's coming on November 1st with the Treasury announcing what their supply is going to be. I've said yesterday I don't like the premise that the Federal Reserve is going to continue to do rates because the bond market is doing the work for the Federal Reserve. So collectively, what's the impact on the market? I'll tell you this from someone who is bullish on the ability for the fourth quarter to be positive, driven by the Magnificent Seven. Today's an ugly reversal. Today is not a day for the bulls. Today is a day for the bears. This is not a pretty reversal. And the only thing keeping the market from deteriorating further is Apple, Alphabet, and Microsoft. They are providing a degree of resiliency from the market moving even lower.
Well, we're going to get into really what's at stake. We got Netflix and Tesla after the bell, too. So you got a good test for the Nas. I mean, Apple right now is negative. A lot of, Microsoft and Alphabet are barely positive. Jimmy, I'll go to you because you are a representation of the bullish perspective. So you got rates. It almost feels like that 5% on the 10-year is formality at this point, that it's going to get there. Not that far. What are we, 8 basis points away?
Yeah, it's pretty close. Look, that's certainly an issue. I'm not sure that that's the issue facing the day today. I hear you, Joe. I actually think that it's the Middle East. I mean, that news from yesterday about the hospital was jarring to everybody. And I think the markets have been on edge for several days. Wouldn't yields be lower? What's that? Wouldn't yields be lower for the Middle East? I'll come right back to it. I got you. All right, I hear you on it. All right, but I think the equity markets right now, I think they're a little bit on edge on what Iran's saying, which, by the way, you don't sell on every time Iran rattles the swords. You'd have no money at this point in time. I think that's what got the equity markets on edge.
So I want to say a thank you to one of my clients who's a listener, and I'll just mention him by first name. He knows who he is. His name is Greg. Greg, thank you for this. This is a piece that he sent me from the Wall Street Journal, and it's very interesting. I want to show you a couple of charts, and this shows the impact of Treasury bonds on portfolios. So this is the impact that long-term bond rates have had on portfolios. This goes all the way back to, I don't know, it looks like a 1945 or so. So it's a picture of the value of long-term bonds and the impact that rates going from, on the bond yield, going from, say, 2% up to 5%. and interest rates going from 0 to about 5%. And the impact that that has on portfolios. And so you can see for this period of time, particularly back to the early 80s, so about 40 years, you can see that bonds have basically gone up. So they have provided a counterbalance to equities. So on a daily or weekly, monthly basis, as equities go down, bonds would tend to cushion that. Not completely, but in a satisfactory way. But the general trajectory was the same as equities, generally up, a very good combination. But what happened is that interest rates hit 0, bond yields hit, let's say, 2%, and they had nowhere to go but up, which meant bonds and bond funds and bond ETFs had nowhere to go but down. And that's exactly what you see at the end of this chart. And that is the reason for the Wall Street Journal article, was because this has had a devastating impact on portfolios, traditional 60-40 buy and hold portfolios. And you've heard my comment on that in the past. And so, yeah, those portfolios, some of them are literally underwater, no question about it. Others are struggling to eke out 1% or more, any kind of a gain for this year. And of course, last year they were devastated by probably on average about 20%. So not very good. But anyway, I've been harping on these buy and hold portfolios and bonds for as long as I've been doing videos, which is approaching 2 years. Before that, I was doing webinars, and I was, saying the same thing for at least another year back, and saying, be careful. There is risk here. There's interest rate risk, etc. And that's what we've experienced. So here you are. If you're in a buy and hold portfolio and your portfolio is down like that, what do you do now? I can't give you advice without knowing your situation, but it's not a pretty picture. And when I look at the long-term picture on bonds, the long-term cycles, they go for 2 or 3 decades in one direction or the other. This one went for 4 decades. But if you go back before that, I think it was 3 decades. And they don't go straight up and they don't go straight down. They zigzag their way up and they zigzag their way down. But I would say, looking at that pattern, I would say a decade to a decade and a half would be minimum. And they could go for 2 or 3 decades or more, where bonds generally will be moving in a downward direction. I don't know that for sure. I'm just saying that has happened through the last 2 macro cycles, going back to about 1945. The next chart also came from the same Wall Street Journal article, and showing the impact that this has had on portfolios. This is just using a hypothetical 60-40 portfolio and showing the gains and losses of those portfolios. And so there have been years of losses. You can see that below the line, but you can also see the last pink bar down was last year. You can see the little piece up is this year. Of course, this is through September. After the month of October so far, I'm not sure how much of a green bar there's going to be left, because bonds and stocks have definitely taken a hit this month. So anyway, the comment on the chart, I don't know if you can see it, says the biggest loss since the 1930s. The 1930s. And the reason is what I just told you. Interest rates going up, bond prices coming down, first time in 40 years. Traditional advisors say we didn't see it coming, etc. But I'll let you evaluate those comments yourself. I wanted to just say, I was thinking, what are the kinds of risks that are out there? And I know there's a lot of them, and they just kind of go through my head, and I think about them a lot. So I just wrote them down. I just thought I would read them to you. The first risk out there, all of these are headwinds on stocks, and many of them also on bonds. Inflation, still high. Interest rates, high and going higher, apparently. Mortgage rates above 7%. putting a huge headwind on mortgages and home purchases. Student loan debt, 1.7 trillion. And you know that as students who borrow money, they can't get out from under that debt. You have to pay it back. And if you don't pay it back, you can't declare bankruptcy. It follows you. And it's like income taxes. If you don't pay your income taxes, that liability follows you. So unless there's some kind of reform that's done, 1.7 trillion. I looked up the average monthly loan payment for students on their student loans. The average payment is $503 a month. Now, there was a moratorium after COVID, so they put a freeze on making payments. Now, this month, they reinstated that, and if the average payment is $503, students or people, let's say young people, let's just say they're in their 20s, young people who are facing these loan repayments are going to start getting hit with $503. Do you think that they can afford that? Probably not. Or it's going to be very, very painful. But yet, you can't get off from under it. You can't refinance it. You can't discharge it in any way. You have to pay it. That's sucking money out of the system, out of the economy, and is also eliminating, for that block of people, which is a large block, eliminating a lot of discretionary spending. The U.S. debt is 33.6 trillion, and climbing rapidly. The U.S., I don't usually cover this, the U.S. unfunded liabilities, these are liabilities we have, debt that we have, obligations there is not money set aside to pay for it. $194 trillion in unfunded liabilities. And the Fed is selling bonds into the market. They're selling about $100 billion a month of bonds into the market, sucking $100 billion a month out of the market. That's going to pay for those bonds. Cleaning up their balance sheet, but putting a huge headwind on the market. And the consumer is drowning. The consumer has $1 trillion in credit card debt. Now, people don't want to have credit. Most people don't want to have credit card debt. Some of it is because they have to. They get sick. They lose their job. They, have misfortune of one kind or another, and they have to borrow money, and that's the place they can borrow it. There's other people who are big spenders and spendthrifts, and they just, run up credit card debt stupidly. And so that, there's some of both, I'm sure. But I think a lot of people don't want to have credit card debt. But that number is climbing every month because the consumer is drowning. And this is putting a headwind on the economy. And, if you've got, I looked up the average balance. The average balance for a person with credit cards is $7,900. But there are people who have tens of thousands of dollars of credit card debt. So the interest payment is over 20% now. So let's just use 20%. 20% of $7,900, that's about $1,500 in interest. And that's $125 a month in interest payments. That's not repaying any of the debt. So what is the minimum payment? Probably less than that. So it is less than that. So that's difficult. So and then you've got the war in the Middle East. I think we've talked about that. I think that's a significant issue. And then the Speaker of the House creating some kind of uncertainty. I don't doubt that. But a lot of issues. So when I look at this and think, is the market headed up, or is it headed down, or is it stagnant? I think it's either stagnant or going down, because the headwinds are greater, in my opinion, than the growth opportunities in the market. These headwinds are too significant for the market to grow. And so we've been out of cash for a month now. We're going to stay, out of the market. We've been in money market funds for about a month. We're going to stay in money market funds until we get the indication that the market is ready to grow again. It may. There could be some of these things, let's say the war in the Middle East, or, they start lowering interest rates, or inflation starts to come down. You start to get some positive indication that things are kind of turning the other direction. It probably wouldn't take too much to give enough positive momentum. It's still a mess, but I think until something positive happens, I would stay. I am staying, out of the market. So, okay, what's the abbreviation for the U.S. Treasury 10-year bond? ADHD. I think that says enough right there. Thank you for watching. If you have questions or comments, leave them in the comment section below.